Welcome guys to the ultimate Fibonacci retracement strategy breakdown you've ever come across. It's gonna be the most simplistic, straightforward video when it comes to Fibonacci that you guys have ever heard. And I know a lot of people have come across the Fibonacci retracement tool either in courses or videos and truly do not fully understand or grasp how to use it, when to utilize it, and they're just lost with the tool. And in this video, like I told you guys before in the intro, I'm gonna be breaking down exactly the specific steps on exactly when to implement this strategy or implement this tool, exactly how to enter, when to take partials, when to exit, all the ins and outs of exactly how to utilize this tool. Powerful tool, an incredibly high accuracy strategy. So let's go and break this down. So first things first, I want you guys to understand what exactly is the Fibonacci. Now, without getting too technical, because I want this to be I want this to be able to get through to the people that don't even know anything about trading, right? So I'm not gonna get too technical with you guys in terms of the origin of Fibonacci and all these different things, but just to keep it real simple, it's just math, right? So essentially what the Fibonacci tool does is you take a starting point to a finishing point, right? And let's just say from this starting point to this finishing point, this is 100 pips, right? 100 pips. And all the Fibonacci tool does, and I'm just grab a Fibonacci real quick, and this is what the Fibonacci tool looks like. It simply gives you percentages, right? So for example, I have my 0.05, which is 50%. As you can see, this is literally in the middle, right? So if this from top to bottom is 100 pips, then my 50%, of course, is 50 pips. You have your 33%, which is 1/3, right? Your 618, which is about 2/3, right? So there's a lot of different Fibonacci retracement numbers, and people use different numbers. You hear some people saying the 818, the 786. There's so many different numbers, and regardless, the Fibonacci retracement tool is meant to simply put you in trades when the retracement is done. So essentially what the purpose of the tool is trying to help you get in the market and anticipate exactly where the market is going to continue its trend, right? What level is going to bounce back to before it continues its trend. Because when you break down what are the market structure rules when it comes to trending markets, and first things first, the Fibonacci retracement tool is for trending markets, guys. First and foremost, it is for trending markets. So, when the market's in a trend, we understand that the rules of trends are, in uptrends, we get higher highs and higher lows. Period, point blank. Period, point blank, right? And the goal of a trending trader is at these lows, these are where you're trying to buy, right? So literally your entire mindset is understanding the trend, so you know your buy is, okay, I know we're in an uptrend, so I want to buy. And I'm trying to time and predict and anticipate exactly where the market is going to come to, stop, and turn around a continuous trend so I can buy and simply ride the wave. And same thing in a downtrend. Your goal is to sell at high points, right? And then get out lower, right? So very simple. And essentially what the Fibonacci retracement tool does, it just helps you understand what are the levels that the market returns to the most. Now, again, I'm going to say this again because I really want it to click. In an uptrend, you're looking for higher highs and higher lows. So the Fibonacci retracement tool simply lets you know exactly what levels the market is going to come to before it continues. So what that higher low is going to be before it continues to make another higher high. So the thing is, when you have to understand when the market is retracing, right? Because you have simply two phases in the market. We have that impulse, retracement, right? That push, pull. The thing is, it can happen different ways, right? So the market can either, break, make a small pullback and keep going. It can break, and when I say break, I mean break is high, so make a higher high, right? It can make a higher high, make a normal retracement, which is about 50%. So when we say a short retracement, right, or a minor retracement is that, so let me bring these fib numbers back up. So we have it right here. As a matter of fact, let's just do this all over so it's clean. Then bring our fib numbers and put it right here in the corner, right? So we have 3 different levels. The market can either make and this is an example of a sell. It can push, right? Make a lower low make a a shallow retracement is what we call shallow or small retracement, and then push. And typically a shallow retracement doesn't pull back too far. So, a lot of people may be looking for a break and retest after the market breaks a level. You're expecting it to come back and retest. It doesn't always do it. At the end of the day, it doesn't have to do it. The market is going to make lower lows and lower highs. A lower high does not have to come back to the previous level. So typically when you have a shallow retracement, the market pulls back to that 0.33, about 1/3 of the push. You also have, so we're going to have just shallow, right? Excuse the handwriting. Sometimes you may get a normal retracement where the market pulls back. And a lot of times this is where you get that beautiful break and retest that we all know and love before continuing. And typically, right, that's what we call the standard. I'm going to put STAN. This is the standard. And typically this is the 0.50 retracement, right? And then last but not least, you have that 618. And that 618 is typically when the market makes a deep retracement. And certain people like the 786. But personally, I love, and I found that in my back testing, the 618 is extremely powerful. I mean, extremely powerful. And what this typically looks like is this. The market will push. And again, you may be looking at this level here as a key level, and it definitely is. And you could be expecting a retest to this level, but the market instead makes a deeper retracement and then pushes down. You have to remember, it's still, in all these situations, the market still made lower lows and lower highs, which is the rules of a downtrend. It still came and made a lower high. It still made a lower high. It still made a lower high. As long as the high is lower than the previous high, we understand that the sell trend is still valid. And matter of fact, let's go back. Let's take a step back and make sure you guys understand the rules of a trend. And once you understand this is going to help you in a lot of your trading. In an uptrend, the market must make higher highs and higher lows. The thing is, every time the market breaks a high just like this, it's letting you know that I want to keep going up, right? I want to keep going up. Of course, it's going to retrace. And when it retraces, it's supposed to make a higher low. So every time the market breaks a high, that low that wants to go break that high, that is anchoring price. So I'm just going to put a little ray right here, right? This right here is anchoring price. So as long as price, and let me just make this my favorite, so I got to keep coming back here. As long as price does not come below this, I know my uptrend is still solid. Now, yes, I know some people may say, hey, the market can still push up. Absolutely, it can. But once my lows get broken, I'm no longer looking for buys. I understand this could be a liquidity sweep depending on your trading style, but I trade like a simple person. Meaning, I don't trade institutional. I keep it very simple and straight to the books, right? So if the market makes a lower high, that could be an easy transition to a new trend. I'm staying out of there. I want to see the market making higher highs and higher lows. Cool. So now if the market breaks a new high, which is this, my swing high, guess what? Now, excuse me, I'm trying to get rid of this for you guys real quick. There we go. Okay, cool. Now this is now anchoring price. And literally, rinse and repeat, if the market was to pull back, push up, and make another higher high, guess what? Now this is anchoring price. The moment the market breaks this low, that's a break of structure. BOS, break of structure. I understand my uptrend is over. Now I'm anticipating a change of trend to the downside. Now, if the market breaks a high, because again, when the market breaks highs, it's letting you know almost to keep going in this uptrend. If the market now turns around and breaks that high, then I understand my uptrend is now resumed and back in action. But if that doesn't happen and the market makes a lower high and then another lower low, this is what I like to call a 1, 2, 3 pattern, meaning the market broke and then broke again. It broke, made that lower high, and broke again. And again, what is the definition of a downtrend? The definition of downtrend is lower lows and lower highs, right? You need a series. You need a series of lower lows and lower highs. Now, if you look at this, guess what? We had a lower low right here. When the market broke this low again, we had another lower low. Now I have a series going. Now I understand we're officially in a downtrend and I'm looking for sells. And the same thing applies. As the market breaks lows, the level that broke that low is anchoring price, is anchoring that trend, is holding that trend intact. The market can start to consolidate a bit and then push down lower. This entire time, I'm still thinking downtrend because the level that is anchoring price did not get broken yet. Now, of course, I'm not going to sit here and be a fool. If the market does begin to consolidate, I'm going to obviously begin to, put that into consideration. But ultimately, this is what's anchoring price, so I'm waiting to see what the market does. And if it breaks this level, as we've seen happen in this example, then now this is anchoring price because this is my lower high, and the market now progressed to make a lower low. So now that we understand how trends work, let's see when exactly do we apply the Fibonacci retracement tool. The Fibonacci retracement tool, again, is to help you time the end of pullbacks. So when the market breaks a high and it begins to pull back, this is when you apply your Fibonacci retracement tool. I'm going to say it one more time. This is when you apply your Fibonacci retracement tool. The market needs to be trending. Every single time the market is in a trend and it breaks a high, if we're in an uptrend and it breaks a high, is letting you know that trend wants to keep going in that direction. After an impulse, you're going to get a pullback. The purpose of the Fibonacci retracement tool is to help you know where the pullback is likely to end so that you can continue on with the continuation. When the market creates a new high and begins to pull back, this is where you draw your Fibonacci retracement. In an uptrend, you take it from the low, the candle body low, to the candle body high. Not the wicks, because the wicks can be really crazy and really long. It might get really crazy, especially if there's news. You might have a wick that's so long that it just distorts everything. So you want to go from candle body to candle body. I'm going from the low, which is my number 1, to my high point, which is my 0. And like I said, what is this golden ratio? This golden ratio is the levels I'm going to buy from. I'm not just going to buy when the market hits these levels, but I'm looking for confirmation of rejection to the upside at one of these 3 levels. So every time the market breaks a new high and begins to pull back, I have 3 possible options at where I'm going to place a buy opportunity. It's going to be one of these 3 levels majority of the time before the market pushes back up and creates its new high. And literally, that is all you're doing. So again, I'm going to show you some really simple examples, and we're going to go to the chart and actually go through step-by-step back testing results and step-by-step breakdowns of exactly how to use the strategy in depth. I'm just going to show you guys a classic uptrend, right? Picture perfect uptrend. And I'm going to help you guys understand exactly when you would have applied your Fibonacci tool for each one of these. So again, first step is I have a trend. I established a trend. How do I know that the market's in a trend? Is making higher highs and higher lows. Once I see it's making higher highs and higher lows, I'm waiting for the market to break a high. When it breaks a high, just like when this happened, right? Just like when this happened, the moment we had a candle closure above the high, I know we had a break of the high. The market wants to keep going up. It's time for me to watch and wait for the market to start pulling back. Once the market begins to retrace inside, starts to pull back, this is when I grab my fib and I take it from the body low to the body high of that impulsive move. From the body low, the body high of that impulsive move. And then I allow the market to pull back to one of my this is the golden area, my golden zones. I allow the market to pull back to one of my golden zones. And if I get a rejection confirmation candlestick pattern confirmation at this level, I buy. Stop loss right below the candlestick confirmation. Take profit 1 is, of course, your initial high. So if I bought off of this, my take profit 1 will be this high. My take profit 2 will be somewhere above it in case the market went ahead and made, it kept going into that trend. Now, let's keep it going. The market went ahead and broke again, made a new high again when it broke this level. So can I allow it to push? Once it starts to pull back, I grab my fib from low to high. I wait for it to pull back to one of my levels. In this case, pull back right here. I get my candlestick confirmation right here, and I buy. TP1 is here, and TP2, you know what I'm saying? And that's where we go into Fibonacci extension to see where is it gonna go further before it starts turning around. I'm gonna go over Fibonacci extension in a separate video. So, and then same thing, right? Let me just kind of get this out the way because I want to keep the chart pretty clean. But same thing, every time you get an impulsive move where the market breaks a high, so just like right here where the market broke that high, candle closure above, once the market began to pull back, you're taking your fib from your low to your high, the market pulls back to one of your levels, and you wait for your confirmation to take it. And an example like this where the market pulled back in between, it didn't reject off one of my levels, this will just simply be no play. Now, an example like this, I'm trying to find, kind of a perfect example for you guys. And as you guys can see, I obviously drew this, right? But an example like this, right, from low to high, notice how the market came and bounced. Let's say this was, let's adjust this. Boom. Let's say it was just like this. Notice how the market came and rejected right off my level right here. It came and rejected right off that level right here. That's what I want to see when it comes to my Fibonacci retracement. So let's go into the market, the actual market, and see if we can apply and how we would apply this strategy in the live market. So like I said, guys, you want to see a trending market. And let's just notice, start from right here where the market obviously was in a downtrend, right? Was in a downtrend, making lower lows and lower highs. And I want you guys to be able to identify when you had that change of trend. And that's super key, guys. If you notice, the market had this high, and then you had that first break of that high over here. So this is kind of what disrupted that downtrend. And once we had that, notice the market started to make higher high, higher low, higher high. I understand now we're in an uptrend. So now what I'm doing is I'm taking my Fibonacci point from my low to my high. Notice that we had a break of structure right here. This candle broke structure. So I'm pushing and I'm waiting for it to start to pull back. Once this began to pull back like this, I go ahead and grab my fib. Now again, guys, let's zoom in. This is my low, right? Notice we have a wick and we also have a candle body low. The lowest point where we have a candle body. You want to start your fib from the candle body, not the wick, because the wick can be crazy. Sometimes you have a news wick, sometimes you have crazy wicks. You don't want to get trapped in it, right? So I'm taking my Fibonacci tool from my low to my high, right? Excuse me. So I just want to zoom in to make sure I got everything clean. I kind of got OCD with my trading. I like to make sure everything is super duper perfect, right? So boom, this is my highest point. We can zoom in and just double check to make sure, right? Get these little drawings out the way. Obviously, this is my candle body high, right? So I got it from the low to the high, right? Cool. Now, understand the market began to pull back, came to my 33, rejected a bit, came lower to my 50%, gave you this beautiful pin bar, and then rejected to make a higher high. So let's go ahead and go into detail. Let me remove all this, and let's go ahead and clean this chart up to see exactly how we would enter this, right? So boom, coming from this low to my high point. When the market rejects, when it comes to my golden zones, first it came to my 0.33. And let's just see what happened when it came to my 0.33. Notice we got an engulfing candlestick pattern right here. Now, this is an example of a confirmation, a trigger to get into the trade. Literally is that simple. I got a break of structure, a pullback to my 33%, and then I got a trigger to enter. Now, notice what happened with this trigger. Now, the way I enter my candlestick patterns personally is different from majority of people out here, and I honestly think this is the safest way and the highest accurate way to enter with candlestick patterns. So any candle, regardless of how the candle looks, pattern or not, you know, let's just draw a regular candle like this. Let's just say this was this is a bearish candle. Let's say this was my confirmation candle. So after this candle, you know, I want to get into my trade. Now, typically, most people would enter right after the candle close. So the candle closes, right here, they enter right here. Personally, what I do is I set a sell stop, and I don't enter where everyone enters. I enter just a few pips below, just like this. And the reason I do it is because there's a lot of times that, you know, right after you get an engulfing, you know, a lot of people seen that engulfing, or a lot of people seen that pin bar and enter right away, and the market literally immediately turns around. I hate those, right? So the reason why I do the sell stop is because every single winning trade that everybody else takes, I still get into that same trade. I just miss maybe 2 pips. But I'm able to win out and avoid some of the losers that everybody else takes by just simply setting a sell stop. So it definitely can dramatically increase your profitability. So let's go and get back into the candlestick. So for me, my entry would have been a few pips below. Now notice how the market, my stop loss always is a few pips again below that engulfing candlestick pattern. So notice how my stop loss, in this case, the market reached my stop loss price on the next candle before ever activating me. So I automatically delete that order. Now, after that, a few candles later, so this is no good, I got a pin bar. Now this pin bar would have caused me to re-enter the trade. Now let's just verify this pin bar real quick. All right. Ooh, okay, cool. So again, and I'm gonna do another video on how to avoid losses with pin bars, to know exactly what pin bars are the good ones and which ones are the traps. So this one was definitely a trap pin bar just because it was smaller than the previous candle. This one was about 15 pips. This one was about 16.5. You definitely don't want to, when you're taking pin bars, you want the pin bar candle to be bigger than the previous candles. So this also would have been a no good for me. And obviously, if you took it and you didn't know the rules to the pin bars, then you would have took this and it would have hit your stop loss. So let's just make this red. Let's just say it's a loser. We're going to make it a red arrow. Let's say you took it and that was a loser. Cool. Let's do a long position. Stop loss would have been right below, and this would have been a loser. Cool. Again, the market is going to make a lower. It's going to make a higher low. So your job is, I'm trying to figure out where is this higher low going to be. It wasn't going to be a 0.33 retracement. Obviously, it didn't work. The market failed and kept going lower. And then it came to this, to my 0.50, and look at this beautiful pin bar candle. And I know this isn't the textbook pin bar that we all see, just like this previous one, but obviously you see the rejection. The market had an extremely huge bearish candle, came to our 50% and rejected quick with a lot of force. This would again be your trigger, a few pips just above. So then there's a buy stop, just a few pips above, just like this. Stop loss, just a few pips below, just like that. And that will be your entry. TP1 would automatically be the high. So, you know, a 1 to 1.3 was automatically smashed. And we're going to change this one to green because this was a winner. And then, of course, if you went for, like, let's just say a 1 to 3 risk to reward, obviously that eventually got smashed also. Cool. So you had your first one was a loser. You had your second one. It was a banger. You were able to find the retracement, and the market was able to go ahead and push in your favor. Now, notice the beautiful thing with this Fibonacci tool is we already have our high drawn. So notice at this point right here, we had a break of the high, of our high point. This candle broke our high point. So now what do? Let's go ahead and readjust this to get it out of our way a little bit. Lock it. Okay, cool. So we do the same thing. Once the market began to pull back like this, we grab our fib from the low. What's our previous low? Literally where we took our trade from. So that's over here from our low to our high. Now, again, the market, after breaking our high, pulls back, came to your 0.33, blasted right through. So obviously no trade. Came to your 0.50, and look, it gave you a beautiful, strong inside bar candle to put you in this trade. And you can see you got a strong bullish candle, and then the candle right after that broke and closed above this high. Even if you waited for the conservative method and entered right here, you still would have been able to get a great trade. Again, TP1 is the high. That's a 1 to 1.7 automatically smashed. Going for a 1 to 3. That got smashed too, and the market kept going for a 1 to 5 before it actually turned around. You probably would have been able to squeeze a 1 to 6 risk reward out of this trade. And it's literally rinse and repeat over and over and over and over and over again. So again, we see the market broke this high right here. Once we get the break of the high, we wait for the market to start to pull back, and then we look for our retracement. So in this case, the market, and let's just get this out the way a bit. So we go from our low body to our high body, right? And we can go, let's just go right here. Cool. Because this is our high point before the market started pulling back. So once it started pulling back, it came right to our 0.33 right here and gave an engulfing. Now, before we got an engulfing, we got this pin bar. Now, this pin bar, I would not take simply because, again, the candle right before it is bigger in size than the pin bar. We don't like to see that with pin bars. Cool. So next after that, we get this beautiful engulfing candle. Would I take this engulfing candle? Yes or no? No. Common sense. Let me tell you why I wouldn't take this engulfing candle. It follows all the rules. It does. It follows exactly all the rules. However, look at the risk to reward. If I said my first TP is the high, which in this case obviously is this, and my engulfing is here and it closed here, if I entered right here, that my TP1 is 2 pips away. It wouldn't make any sense to do that, right? So if you have a horrible risk to reward, don't take the play. Don't take the play. Just wait for either the market to make a deeper pullback or for you to get a new setup. Now, notice the market wicked. We had our high point. The market did not close above the high of that wick. It wicked up and came right back down, made a deeper retracement, came to our 50%. And the market isn't always going to give you clean candlestick patterns. It's not all the time. Sometimes it will, sometimes it won't. And notice here you got you another inside bar candle. And this one, of course, you would obviously have to take it the aggressive way, just like that. That bearish candle was way too big for you to take it the conservative way. And obviously, look at this risk to reward. You get you a 1 to 2 risk to reward, right? 1 to 2 risk to reward, and then you get you it pushes for a 1 to 6. If you're able to squeeze out a 1 to 6 before it starts pulling back again, right? So obviously, you guys see right now we're already 4 for 1, 4 wins, 1 loss. Well, this wasn't a trade. 3 wins and 1 loss. And you see each one of our wins have great risk to rewards. And literally you just keep progressing with the trend. And when the trend changes, you change with the trend. So let's continue. Right? So boom, that's our entry right there. Next, the market go ahead and breaks that high again. So once it starts to pull back here, I'm looking for an entry. So I go from my low point to my high point, right? My low point to my high point, and let's see what happens. So the market make a pullback. Let's see where we at. Boom. The market starts to pull back, gets close, does not touch it, didn't touch it, so it's not valid to me. Came and came to my 0.50. Again, gave me a pin bar. Look how small this pin bar is compared to the last, this big candle that just came 2 candles ago. That is ugly, right? You have no candlestick pattern confirmation in your golden level. It comes here, gives you a black candle that breaks right through it, gives you another black candle right here that breaks right through your level. You get no confirmation at your level, no confirmation, no trade. The market comes below your 618, gives you a engulfing. So it probably came to the 786, pushed up, failed to make a higher high, made a higher low, and then began to come lower. Now notice what happened. Again, this is your golden area. If you don't buy here, you don't buy, period. And you just literally sit down and wait. Notice the market broke our low, so we know this is a possible change in trend, right? If you already didn't see the market start to make these lower highs and lower lows, this definitely confirmed that break and trend and that switch to the downside. So now you will simply be taking your fib and doing it the opposite way, right? So literally, I'm going to go from high to low point, high to low point, and notice the market came right to my 0.33 and gave me a beautiful, beautiful, beautiful pin bar. All right, so this will be a sell entry. This will be a sell entry, right? TP1 is obviously that low off rip. Probably gave me like a 1-to-1. Let's see. Got you close to a 1-to-1, right? And then if you shot for your 1-to-3, that obviously got smashed. And then notice the market broke a level. Once it broke a level and began to pull back, you're looking for your entry. So from my high point to my low point, wait for the market to make a pullback. In this case, the market made a very, very shallow pullback prior to the 213 or the 23, and then push back lower. So you didn't get a trade this time. And guess what? The market broke a low. So again, I'm waiting for the pullback. So when I start to see the market pull back, I'm grabbing my fib, going from high to low, right? High to low, got us a beautiful pin bar right here. This literally would be your entry. Boom, just like that. Just like that, right? And obviously, if you know, the recent low was really, really close. So you could have avoided this trade. If you did take it, you were able to get like a 1-to-2 before it pulled back. This could have been an easy trade to avoid because of the risk reward, and I completely would understand that. So then you just simply move on to the next one. The market broke another low on this big candle. So when it began to pull back, I'm doing the same process. I'm doing the exact same process. I'm going from high to low, right? So the market did this impulsive move. Let me change the color so you guys can really see this to green. It made this impulsive move. So I'm timing the pullback to continue the drop. Now, obviously, right? Obviously, as the market, let me zoom in again. As the market pushed down and broke this level, oops, we had this floor, right? As the market pushed down and came to my golden levels, I had no confirmation. It just broke, closed right between it, closed right above it. So it is what it is. I'm not worried about it. I just don't get no play. Now, notice, and it's just rinse and repeat. We can go over this over and over and over and over again. And the thing about you want to understand and always remember is you only use this in trending markets. And actually, we just came across some consolidation. So let's see how we would have avoided or been able to, adjust or maneuver between the consolidation and how you can avoid it, right? Because in a trending market, consolidation is your worst enemy if you're a trend-based trader. So obviously, this is my high, and we see the market broke our high. So once I see the market, this high right here made a lower low, and then it got broken. That's a break of structure. It's not supposed to do that. So once that happened, I'm done selling. Until this lows get broken again, I'm done selling. Obviously, that happened right here when we had a gap down. Once the market gapped down, I'm resuming my selling. So coming from high point to my low point, again, got a pin bar right here. This is another sell, rinse and repeat, literally. Another sell right there, right? And you would have been able to get at least a 1-to-1 right there and a 1-to-1.5 before it pushed. Now notice, after that, we got a lower low. And again, our trend got disrupted when this high got broken right here. We're not supposed to get higher highs. Okay, just because we broke and made a high does not mean we're automatically in an uptrend. We need now to make a higher low and a higher high. We need to break structure again. Remember, the definition of uptrend is a series of higher highs and higher lows. So you need 2x. You need more than one. You need a series, right? So if the market doesn't break this high, I'm not buying yet. I'm waiting for a trend to occur. And notice this same level, the market did not break for quite some time. So literally, if the market comes and makes a lower low, I know the trend continues. If it makes a higher high right here, I know we're going into an uptrend. So at this point, I understand what's going to happen. And look at this consolidation. Look at all this consolidation, right? So simply just waiting until the market determines this trend, that will put you in and that's the market condition. You want to make sure you're in before you're trading Fibonacci's. And that's going to keep you out of a lot of trouble. So let's go ahead and real quick review all the rules to make sure you fully understand. Let me give you guys a couple other tips on some other tools and things you can do to improve your accuracy with the Fibonacci. So step number one with the Fibonacci retracement tool is identify. As a matter of fact, let's just type this out. Let's make it real pretty. Let's make it pretty for y'all. All right, because I've been drawing. I know y'all don't like my handwriting, man. I know y'all don't like it. It's okay. I don't like it either. So step number one, right? Identify the trend. And I'm letting you know right now, if I bully any words, I'm not a spelling bee champion. I'm a trader. All right. So, secondly, identify the trend. Second thing I'm trying to do is I'm waiting for a break of structure, right? So if I'm in an uptrend, I'm waiting for a break of a high. Then so this is a buy example. So waiting for, we're gonna edit that later. Once the market begins to pull back, you want to draw. Oops. Okay, let's edit this. Once the market begins to pull back, you want to draw your Fibonacci, right? So in an uptrend example, EX, in the uptrend, we're going from low to high of candle body. That's important. 4, wait for pullback to the golden zone. Wait for candlestick confirmation to enter, right? And then your SL, few pips below, or I'll just say behind, candlestick pattern. And then buy. I'm gonna put this with the buy or sell stop so you guys don't forget that. Buy or sell stop, right? A few pips ahead. And then your stop loss is a few pips behind. Candlestick patterns, we're talking about this like 2 to 4, literally, nothing crazy. Like a point or two if you're on indices. And your take profit, one is going to be whatever the high is, right? So the most recent high that you have. And your TP2 can either be based off of Fibonacci extensions, which I'll break down in a different video. Again, comment if you guys want that breakdown. Or you can go for a risk to reward. I advise like a 1 to 3, 1 to 4, 1 to 6, whatever risk to reward, because you expect the market to go ahead and, especially if it breaks that level, you're going to expect the market to go ahead and make another higher high. So this is a simple Fibonacci retracement strategy. Extremely effective, guys. I'm talking about as you guys can see, over 70, 80% accuracy if you stick to the rules. Here's a big tip. Stick to one time frame. And what you want to have is You want to have a guide time frame, right? And I'm gonna break this down in a different video, which is a higher time frame. So let's say you trade the M30, you want to, maybe a 1 hour or a 4 hour, right? 1 or 4 hour guide, right? Which is just letting you know your trend. So like if your 4 hours bearish, you want to make sure you're selling on the M30. You want to have a primary time frame, which is the time frame you actually trade. So here, that will be the M30, where you're actually taking your trades and you're sticking to one time frame. Don't jump from time frame to time frame. Keep it very simple and straight to the point, and you guys will see how effective this strategy is. Works on currencies, works on indices, works on stocks, works on cryptos. It works everywhere. It's math. It's literally math. You feel me? So hope you guys enjoyed this video. Make sure you comment, subscribe, like. If you have any questions, go ahead and drop it down in the comments. If you guys want more strategy videos just like this, let me know. I'm gonna continue to break this down, continue to give you guys more sauce right here on the YouTube channel. And if you want the personal mentorship, go ahead and reach out in the comments. I'm gonna reach out to you and we're gonna get that set up. All right, y'all have a phenomenal rest of your day.